Hey, it's John F. Gately. Welcome back to the channel. Wow, I want to talk about Biden's whopper of a lie that he told the whole country this morning at his 9 a.m. statement relative to Silicon Valley Bank. But before I play the lie, which we'll do in just a second, I just want to notice the massive difference between how the Biden administration had handled the Ohio train derailment and how they've handled the Silicon Valley Bank derailment. They were very, very quick to help out their friends in the venture capital world, not so much to help out your average American in Ohio. Let's play the lie. Here we go.
No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund.
Oh, no losses by the taxpayers because it's all going to be covered by the fees that the banks pay into the deposit insurance fund, the FDIC. Oh, well, so the banks pay an insurance premium into the Federal Deposit Corporation. There's a formula for that. And don't worry about it. They're going to pay. But wait a second. Where do the banks get the money? They get it from us. They get it from us, from depositors, right? So at some point, the FDIC is going to want their money back. And one of the ways they're going to get their money back is they are going to sell some of the assets from Silicon Valley Bank, and that will recoup. But for everything that's not recouped from there, effectively, as the president admitted, those monies are going to come from the bank insurance premiums, which are paid by us, the depositors. So while technically you can say there's no taxpayer money involved in the bailout, and this is totally a bailout, there is money paid by the depositors. So your average American, the average Joe, mechanic, nurse, policeman, firefighter, whatever you do, you're going to pay for this in the form of higher fees at your bank. Because the bank is going to be charged higher insurance fees by the FDIC, and they're just going to pass that on to you. Now, there's at least two other ways that these costs from this bailout are going to be passed on to you. Number one, over the weekend, and we won't get into the details of this, but effectively the Federal Reserve, how do I want to say this, printed more money. That's the most simplistic way to think about it, in order to backstop Silicon Valley Bank and the other mid-sized banks that possibly could have had a run today. In doing that, effectively the Federal Reserve injected more money into the banking system. In other words, kids, last week there were $10 bills in the world, and this week there are $11 bills in the world. Therefore, dollar bills have a lower value than they did last week. In other words, the solution is inflationary. The solution is inflationary. Not maybe to a huge extent, but to some extent. And while the American taxpayer is not going to pay that directly, all Americans will pay that directly, right? So you see the lie in Biden saying that the American taxpayers, okay, it's just that everybody's going to pay. And the other reason that you're going to pay for this is, if you might not be following this Silicon Valley Bank failure, and we're going to talk maybe a teeny bit about the source of that or why that happened big picture later in this video, but the failure is being used right now to talk the Fed into pausing interest rate hikes. So about a week ago, the Fed debate about how high interest rates might be was bordering somewhere between should they hike a half a point or should they hike a quarter of a point. That debate has now completely changed into should they hike a quarter a point, or maybe they shouldn't hike at all and just leave it where it is. So that debate has changed, and in either case, that is inflationary because the Fed is trying to raise interest rates to combat inflation. And so once again, the federal government response to this is inflationary because it's probably going to reduce or retard their response to inflation, and you're gonna pay for that. Which is also feeding into Biden's lie that he told us today, no taxpayer funds, it's just everybody's funds are going to be paying for this. Now, two more things. One, I'm not a financial advisor, and don't take this as financial advice. I'm like the last person you would take financial advice from. But now, lastly, there are basically two parties at fault here. In the micro, it's the bank, Silicon Valley Bank, and their woeful mismanagement of risk. They did not hedge enough when they bought these long-term treasuries. They did not hedge properly, given that their deposits that they had were to be paid out on demand, and they bought long-term. That's the big story there. They mismanaged the deposits. That's the micro. On the macro is the Federal Reserve itself. For years, they kept the United States at basically a 0 to 3 to 4% interest rate environment, like for mortgage. You get a mortgage for 3.25 or something like that. And the money that you got in interest at the bank, it was a joke. You got 0.1%. You got basically no money if you had your money parked in a bank. And they kept it like that for a really long time. For many of you, if you're 34 years old, you probably never lived as an adult in a normal interest rate environment. You've been weaned on this 3% interest baloney, where if you're a little bit more if you're a geezer like me, then you've been through a couple of these cycles and you understand that 7% interest is historically, on average, normal. And what's happened here is the Fed kept the interest rates so long that when they finally did have to hike them, which they have been doing since the summertime, right? That hike had to be exponential. It had to be a lot really quick. Let me give you an analogy. If a restaurant, let's just say the sandwich shop, it's downstairs on the first floor, if they don't raise their menu prices for like 4 years or 15 years, and then all of a sudden they raise their prices, you're really going to notice a lot. That's why when you run even a sandwich shop, or if you run the Federal Reserve, you always want to be increasing your prices just a teeny bit, a little bit here, a little bit there, because otherwise you get behind the curve, and that's when you have to raise interest rates very, very quickly, which is what we've seen. The root cause of this problem is the differential in the bond rates paying today, if you bought a bond today, well, last week, versus if you bought a bond in 2021. All right, so, hey, I'm John F. Gately from Plymouth, America's hometown in Massachusetts, behind enemy lines. Have a great day. Bye-bye.